Happy Saturday, everybody. Guys, are we hitting another wave of inflation? Gold is at a record high. Oil is breaking out. Financial conditions are loosening, and Larry Summers just completely went off on the Fed.
We heard from Chair Powell this week, speaking at Stanford, where he said, yes, we are restrictive in our policy, and yet he quite explicitly said he doesn't need to worry about where the neutral rate is for policy going forward.
That is like saying we don't need to know what the neutral rate is like saying you should drive your car on feel without looking at the speedometer. My view is that the evidence is overwhelming that the neutral rate is far higher than the 2.5%, 2.6% that the Fed talks about. That evidence comes from four places. First, we have high interest rates, and we have an economy that is, if anything, growing faster than its long-run potential, creating jobs as fast or faster than natural growth in the labor force, even allowing for immigration. Second, we have an economy with financial conditions that are extremely loose, that are actually looser than they were before the Fed started the whole tightening process. Third, if you look at the market's estimate of the long-run neutral rate, that neutral rate is comfortably above 4%. Fourth, if you look at the fundamental determinants of the neutral rate, we have big surges in budget deficits that, if anything, look to get worse. We have big changes in resilience investment, in green investment, in new investment, data centers, along with deglobalization, which may limit capital inflows. So whether you look at the fundamentals, you look at market estimates, you look at financial conditions, or you look at the current strength of the economy, it seems to me the evidence is overwhelming that the neutral rate is far higher than the Fed supposes.
He stopped short of calling them names, but he did not pull punches, guys. He gave some really great reasons as to why we should not even be thinking about rate cuts right now. And then listen to what Neil Kashkari says from the Federal Board of Governors.
Ultimately, we've been surprised in a good way that the economy has been very resilient, even though we've raised interest rates a lot. So if we continue to see strong job growth, if we continue to see strong consumer spending and strong GDP growth, then that raises a question in my mind. Well, why would we cut rates? Maybe the dynamics that we have right now are actually sustainable.
Here's another question. Are rate hikes off the table?
No, they're certainly not off the table. I don't know of anybody who's taken them officially off the table.
Now we have a possibility that there's no rate cuts in 2024. We have a possibility, even though he says he would be surprised if this happens, that we could possibly even be raising rates. We are seeing gold and oil break out. Guys, to me, these are suggesting that there's fear about the currency itself. And that is not great if you were looking for a housing crash. Now, I'll tell you, what we are seeing in the housing data is very hot. We are continuing to see prices increase. Take a look at this. The median price per square foot, this orange line, this is for Nashville, guys, but the median price per square foot is hitting an all-time high here, okay? So median price per square foot is skyrocketing, all right? Now, when we look at the median price, guys, if it was taken today, would be at an all-time high, be tying the all-time high, and you can see we may or may not break through it at the end of April. It's going to be close. Right around that 500 mark seems to be where a new it's stabilizing there, okay? Prices are going up. And I got to tell you, this week I've seen interest-only loans from multiple banks offering interest-only jumbo loans. That is not tight financial conditions. We're seeing buyers just come out in droves for certain houses. I had a buyer this week for $1 million house. It had multiple offers on it. $1 million house, fairly priced. It wasn't like super cheap, but it was fairly priced. $1 million house had 4 offers on it. 2 additional offers were going to be made, but they decided not to because they had a home sale contingency. And then my buyer, that was 7 people looking at this $1 million house. We also had, let me show you another one. Okay, this house had multiple offers. Now, this is a beautiful house, right? It was a beautiful house on a good lot, but guys, $370 a foot for this house. Okay, it had multiple offers. Now, to give you an idea of just how wild this house is, by the way, 0 days on market. We have to go back to this house, which went under contract a little over a week ago. Let's see, when did it go? March 21st. So a couple weeks ago, this house went for $338 a foot. 1.5 was the price point there. So you got to factor in, it was a little bit more expensive because it was a little bit larger, 4,400 square feet. So 700 square feet larger, went for $338. It went under contract almost immediately. But what makes this crazy, guys, is if we go back just 6 months in this neighborhood and look at closings, we can see on this same street. Now, good, granted, it's not on the cul-de-sac, but it's on this same street, 4,200 square feet, $307 a foot. The point is, we went from $307 a foot in January to $370 a foot with multiple offers. Do you think that this thing is going to go below list? I don't think so. This neighborhood is absolutely scorching. So even though, look at this is Williamson County $1 million inventory. We can see we have more $1 million inventory than we had last March by almost 20%. Okay, almost 20%. I'm doing that in my head, so maybe it's 10, 15, maybe it's 10%. Okay, so whatever, between 10 to 20%, we have more active listings for $1 million homes. But when we look at what goes under contract, look at this. Under contract, we're at a record here. $219 million homes went under contract, more than any other month and any other year. So guys, here's my point. Prices are going up. $1 million homes are moving. Interest-only loans are everywhere. You can see even Tony Jatana, which, by the way, I love his buildings. Like, this is not a critique of him, but he just secured a $230 million loan to build something to be delivered in 2027. And this is, guys, apartments are empty right now. Apartments are empty. We've got easily through 2024 and 2025 supply. And that's if migration stays where it is. So there's a banking on the idea that migration will fill up, that it will continue to fill up all the apartments, and that we will be in even better shape by 26 and 27. So we can also see this by the Chicago Fed. Chicago Fed is showing that financial conditions are as loose as they have been since January of 2022. That's how loose they are right now, guys. That's how loose financial conditions are, and they are. All of this is inflationary. I'm just telling you, I wish it wasn't. I wish prices weren't going up. I think they're ridiculous relative to where rents are. I think there's a massive risk in the market for people buying. And let me give you an example of risk. Okay, this was a buyer, same builder, literally 2 doors down from each other. This 815 Sunset View, 2-bed, 2-bath, 1,700 square feet went for $475. 809 Sunset View, 3-bed, 3-bath, 2,180 square feet went for $478. Obviously, 809 got a better deal by far, but look at this. Their loan was $466 on this house. Okay, their rate is probably somewhere around 6.5%. Maybe they got a concession on rate. Maybe maybe they got bought down the rate to 6. The bottom line is their monthly payment's going to be around $3,500 for this house. It will be well over $3,000 for this house. Okay, my buyer, he put $115 down. He got a loan for $365, and he assumed a mortgage. So he got 2.75% on this house. His payment is right around $2,100, $2,200. Guys, if he had a job change, if he had something significant happen where he had to leave, he would not be a forced seller. He would not be writing a check every month to rent this house. However, this buyer could not rent this house out, maybe $2,000, $2,200. They're going to be writing a check every month for $1,200, $1,300. Or if they sold it, this house would have to go well over $500,000 for them to be able to sell it. They are in a very, very risky position. And it's really sad. Same price, same time, same builder. Guys, it matters how you buy and how you structure your buying. Last thing I want to show you, housing inventory. This was Lance Lambert. Notice it's creeping up for March. Notice that did not happen in 2023. It did not happen in 2021. It did happen in 2022. I said this market has been feeling like 2022. But look, it also happened in 2017, 2018, and 2019. When we think about inventory for this year, even though we're seeing places like Davidson County being at a record high in inventory, and believe me, it's going to be at a record high. It feels and looks soft to me. Big yellow / red flag in Davidson County. Like, you want to be careful there. By the way, and contract volume is flat. Fact is that prices are still holding up very well in a lot of places. Look at this, by the way. Contract volume for Greater Nashville, it's actually now year-over-year negative. Okay, that's a bearish sign. Active listings for Greater Nashville, much higher, 10% higher. That's a bearish sign. So this market doesn't make sense to me. Okay, you say, what do I think about it? I think there's major inflationary pressures. I think prices are only going up right now. I think there are some bearish signals happening, right? 10% increase in active listings might be a bearish signal. Contract volume being flat to negative might be a bearish signal. Just be careful, guys. Whatever you do, and it doesn't matter whether you buy, whether you choose to wait, whatever you decide, be careful. And when you do buy, make sure you have somebody helping you. Even if you're paying the same price, you're knocking it out of the park. Just, you can be smart about buying. And even when the price is the same, you can be absolutely crushing it. And with that, I hope you guys have a great day. I will see you next Saturday.